Hi folks, it's Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and today is Thursday, April 16th, and I thought I'd come to you with a brief market update, kind of let you know what's going on and check in. So the S&P 500 as I speak is up about 50 basis points to about 2,800. That's obviously about 300 basis points higher than the 2,500 level that we've been talking about previously. And the market seems to have found a little bit of comfort around this 2,800 level. We'll see. We've been here for the past couple of days. We may move up a little bit away from it or down a little bit from it, but we've seemed to bounce around and come back to it relatively frequently over the past couple of trading days. So we'll see how that holds. In terms of overall economic news, you saw about 5 million jobless claims this morning, which is remarkable in terms of scale and scope. We've lost about 22 million jobs over the course of the past 4 weeks. And if you think about a workforce that is only about 160 million strong, you're obviously seeing kind of a mid-teen spike in the unemployment rate, which is obviously difficult. The good news is that 5 million jobs that we lost this morning is actually a little bit less than a lot of economists had predicted. But when we deal with numbers of this magnitude, I'm not sure that a few 100,000 one direction or another really makes all that much difference. What will obviously make a lot more difference is the shape of the recovery on the other side of this. To that end, you continue to see conversations out of the administration around when and how to reopen the economy. That will happen in stages. It's pretty clear that as we look to reopen businesses, that we'll reopen manufacturing and industrial businesses first, which is great because that's accounted for almost half of the job losses that we've seen so far. So to get those factories and industries back up and running and get people back to work is obviously a goal of the administration and a goal, I think, globally for the planet to get everybody up and back running to work. We have seen some earnings recently. The banks started earlier this week. All of those look like they've been putting some incremental cash on their balance sheet to make sure that they shore up that balance sheet in the face of any potential bad loans, which we will see as the crisis rolls through. We also saw a report this morning out of Taiwan Semiconductor, which is the world's largest semiconductor company, which is actually encouraging because they both met expectations on their earnings side for first quarter. They actually reaffirmed their guidance for the second quarter and actually issued guidance for the second quarter, which wasn't nearly as terrible as people, I think, were thinking. So the market's taken a little bit of a positive stance from there. Switching away from the economy for a few minutes, I think I've gotten a couple of questions about the size of the stimulus package and the size of the national debt and whether or not that's sustainable or are we just laying the seeds for the next crisis. And there are a couple of things that I want to point out in this regard. While the U.S.'s debt to GDP ratio is slightly north of 100, meaning that we have almost as much national debt or a little bit more national debt than our annual GDP, we're certainly not the worst in the world in that regard. In fact, you can look at a number of developed countries over in Europe that have higher debt to GDP ratios than we do. You can look at Japan that actually has a number that's closer to 200, north of 200. And in light of that, I think it's important to note that just because that number expands doesn't necessarily mean that a crisis is looming. Japan has had a debt to GDP number north of 200 for a long time. The other thing that I would point out about that is that in the current interest rate environment, with interest rates so low, having a higher debt load is actually more serviceable than you might think because that debt just carries a significantly lower interest rate, and it's not like the U.S. has to pay back the principal at any given point in time. So it's just worth noting. The other thing that I would note about this is while it is lamentable that this entire crisis is going on, and it is lamentable that we need to spend the stimulus money that we're spending. Spending the stimulus money in an effort to keep the United States and candidly the rest of the globe out of falling into sort of a giant depression, if you will, is a much better outcome than not spending it. So in other words, from an economic standpoint, the risk of incurring some additional national debt at this point is a heck of a lot lower than the risk associated with the economic fallout if we were to allow the economy to fall back into a depression, or into a depression, I should say. So with that, I hope everyone can, it's once again, it's lamentable, but I think it's necessary at this point. With that, I just want to send out a brief reminder. One of our advisors in Birmingham asked me to remind everybody that scams, particularly financial scams, associated with the coronavirus are on the rise. You're seeing a lot more phone calls and emails and spam out there asking you to reset your password, or asking you to wire money to someone, or informing you of a test for something. And so please, if you get anything that seems suspicious, feel free to run it by someone else, Google it, see if it's legit, or even just reach out to your financial advisor and say, hey, I got this. Do you think it's real or not? Because scam activity definitely has been on the rise, and I want everybody to try and be careful. With that, I hope you enjoy your Thursday. As always, if you have any questions, please feel free to reach out to me or to your financial advisor, and have a great day.